Let's bring in Mike Hawkins, Chief Investment Officer at Evans Partners. He was also a former Chief Investment Officer for Goldman Sachs Private Wealth Management. Good to have you back on the program, Mike. So what's going on in the markets today? I mean, take a look at what's happening with Qantas shares. We're seeing a rally despite this big miss, and then I guess Westpac going the opposite direction. What do you think is going on? Are we seeing some profit taking here?
Well, I think in the case of Westpac, there's a quarterly update, and from our perspective, it didn't look too bad. But I think the local banks made a bit of a mistake in looking for a rate cut from the RBA earlier this month. And I think their trading books, in terms of the trading income, has been a little bit volatile. We saw that with the CBA result yesterday as well. So I think from a quarterly perspective, Westpac looks a bit soft for the market, but I think on a 12-month view, they're pretty much in line. In general, of course, the banks have got a pretty flat outlook for profitability in Australia. The Qantas one is a bit more interesting. The Qantas one's a bit more interesting, I think, because we are, one of the features, it's early in the reporting season in Australia, it's just picking up pace from now, but what we are seeing is aggressive cost out right across many companies. We're seeing restructuring, selling off of underperforming businesses, and I think don't want to be too negative, but that's about all Australia has got going for it at the moment in terms of earnings surprise or earnings support in financial 13-14. We are really going to have to see the cost out really come through to sort of underpin profitability in the market. Profitability here has been a big struggle.
Yeah, Mike, let's move on and take a look at Qantas then, because the Flying Kangaroo really missed profit estimates. We're looking at 42 million Australian dollars. That's how much they made in the first half, which is less than half of what analysts were calling for. First of all, I just want to know, how did analysts get this so wrong? Because didn't they price in what happened with the industrial action in October? Didn't they price in the big fuel charges? So how did Qantas miss by so much?
Well, I think in the analyst's defence in this instance, the leverage in an airlines business to subtle swings in their cost line, having planes on the ground for 28, 48 hours, all those things are very hard to quantify. So inherently in this industry, the earnings from quarter to quarter and half to half are extremely volatile. Clearly the market is seeing an uncompetitive business, of which we've got many in Australia, seeing management, unfortunately, take the aggressive cost-out approach, and that's giving them some confidence about the future earnings base for the company.
Okay, but what about this bounce in Qantas Airways shares? It's up 4.5%. Do you think we're going to see these gains continue, or is this pretty much a bit of a relief rally, considering we do now have an outlook and a plan going forward?
I would say it's a bit more of a relief rally. As I said, from a cost management perspective, I think the market can have some confidence that that is being looked at fairly aggressively. You still, unfortunately, do have the big picture volatility in terms of fuel prices. We're obviously struggling for inbound tourism in Australia. A lot of competition on the Pacific route, Australia-US, which is 2 or 3 years ago, the previous decade, has been a huge profit driver for Qantas. That's eroded. As they've been saying for the last 18 months, internationally, the international routes are under a lot of pressure.
Okay, before I let you go, Mike, let's talk about why you're hesitant to still buy into Australia despite the fact that it's so cheap. I mean, we've seen a pretty good outperformance, gains in the first 2 months of this year. You still don't want to buy in?
Not particularly. We're recommending our clients get out as fast as possible and invest overseas. Effectively, the earnings per share for the ASX 200 is still below where it was in financial 07, and I think it's going to be a struggle for it to do any better in financial 13. So an uncompetitive economy, a poorly structured market in terms of industry diversity and depth, and overvalued currency. You put all those things together, a fairly restrictive policy stance, and corporate Australia is struggling. So you look overseas, a lot more opportunity.
All right. Thank you so much, Michael, for your time. Good talking to you this morning. Michael Hawkins, Chief Investment Officer at Evans Partners, joining us from Sydney.